what does that mean for valuations? Joining me now is Rushabh Desai, the founder of Rupee with Rushabh Investment Services. Rushabh, thanks so much for taking the time. Help us understand this, because, and I'm not sure if you've accounted for today's fall as well, when you pulled up these numbers, when you're looking at relative valuation of Indian indices compared with global indices. But what does the picture tell you right now?
Hi, Alec. Thanks so much for having me on the show. See, first of all, it's been 17 to 18 months where we have seen the markets going sideways. During this course of time, markets have been extremely volatile. Answer is a yes. If you see today, the markets have fallen like anywhere between 3 to 4% on the broader markets, and on the Nifty 50 and Sensex sides, around 2.5%. The market has slided down. Now, on the valuation side, uh, because we have seen a dramatic time correction over 17, 18 months, valuations have turned out to be very reasonable. I pulled out some very interesting data, Alex. I pulled out data of 44 Nifty indices. Now, from 30th September 2024 to 27th February 2026, the average fall of these 44 Nifty indices has been negative 2.6%. Okay. Now, if I factor in the today's fall, then probably the fall would have gone to -4 or -5% over the past, cumulative over the past 17 to 18 months. Okay. Now, coming to the price to earnings ratios, price to earnings ratios have also corrected sharply over the past 17 to 18 months. Over the same period, Alex, from 30th of September 2024 to 27th of February 2026, Nifty 50 price to earnings ratio has corrected by minus 9.2%. The price to earnings as on February month end has been 22. The price to earnings ratio for Nifty 500 index has corrected by 15.1%. The current price to earnings of month end February 2026 stands at 23.5. Price to earnings of Nifty Mid Cap 150 index has corrected by around 29%, to be very precise, minus 28.7. The current PE, month-end PE of February 2026 of Nifty Mid-Cap Index stands at 32.6. And last but not the least, the small cap index, which is the Nifty Small Cap 250 index, has corrected by 22%, and the February month-end PE stands at 26.1. Now, if I factor in today's falls, of course, the price to earnings ratio would have again dipped by probably say 3 to 4%. If you go to see the large cap index and the small cap index are trading below their 10-year average, and the mid cap index is trading close to its 10-year average, including today's fall, Alex. So overall, I feel the breadth of the market is very weak, but at the same time, valuations have turned out to be very reasonable in all three segments, which is large cap, mid cap, and small cap.
Yeah, it's an important point that you make, because I was just looking while you were speaking at the Nifty 50 and I was looking at the Nifty 500. Now, the Nifty 50, of course, is the large cap index, the benchmark, and the 500 includes quite a few of the broader market stocks as well. And both of those indices have actually dropped, Rishabh, 5% as I'm looking at the screen right now in the month of March itself. So the points that you were making on valuation deterioration that has taken place, and you've used the price to earnings multiple metric, has actually come off even more. So if anything, I think the estimations that you might have of that correction in the multiple might actually be a little conservative. So therefore, from that perspective, Rushabh, what does that mean about fresh deployment into the equity markets here in India?
This clearly means it's a very good time to invest, Alex. Whenever we see price corrections and valuation corrections, it clearly displays good and decent margin of safety. This is number one, which is clearly seen in the Indian equity markets. And number two is that when the Indian equity markets enter into a bull run, we will see good amount of upside opportunity. So currently we have good margin of safety, and there is very good upside opportunity in the equity markets. We don't know when things will turn around. It's very difficult to predict, but I feel that earnings have already started to pick up over the past 2 quarters. We have seen robust earnings growth. If I look at the large cap segments, the earnings growth has been in single to probably double digit. But if you look at the mid and small cap segments, the earnings growth, I'm talking about the PAT growth, has been phenomenal of greater than 15%, Alex. Okay, this is year on year. So I feel earnings growth are catching up, have caught up quite good over the past 2 quarters. It is just a matter of time, when all of these geopolitical tensions kind of subside, and when FIIs start to pump in money in the Indian equity markets, I feel Indian equity markets should do really well. So this is a very good time for investors who have some dry powder, some cash in hand. They should definitely think of deploying in a staggered manner, Alex.
But so, Rushabh, having that dry powder, as you've pointed out, or cash available, is easier said than done, because a lot of people look at those corrections and they've seen a few opportunities in the last several months, and you've had the geopolitical tensions in our backyard also, where you saw markets drop and a lot of people did deploy at that moment. And so a lot of people are saying now, Rushabh, that they don't have the cash. How do you generate that dry powder?
See, if you don't have the cash, then just stay put. This is not the time to sell. Okay, because I'm sure portfolios would have the returns of many portfolios would have been subdued, and some investors or quite a few investors would have seen negative returns in their portfolios as well. So number one, this is not the time to sell. Number two, if you don't have dry powder, just stay put. Markets will eventually recover, and you will witness good returns when the bull market arrives in the Indian equity markets. Okay. Now there are two ways to generate dry powder, Alex. See, number one, I tell this to my clients that always keep 5 to 10% cash in your portfolios. Now, what I mean by in your portfolios is have liquid funds or short-term debt funds, and park 5 to 10% of your overall portfolio, so that you have some money to deploy during these kind of markets fall. This is number one. Number two is another way to generate cash is that when markets turn really expensive, when the valuations start trading above their 10-year averages by a decent margin, then you may want to book some profit. But I understand that the markets have been painful over the past 17 to 18 months, and we have been recommending to go in a staggered way over the past 6 7 months. So it is very natural that many investors out there may not have cash in hand at this point of time. Just stay put. I think even over the past 6 to 7 months or 10 months, investors those who have invested would have invested at very good levels. So I don't see any reason to worry, even if someone misses today's dip.
Okay. Having said that, uh, if you have that 10% of cash available, and so you have a certain amount of dry powder, would you say that you use a staggered manner in which to deploy it even from now, and where would you deploy it?
Absolutely, Alex. I wouldn't go all in at this point of time, because the geopolitical tensions are definitely here to stay. I don't think they would subside soon. So I think probably say deploy anywhere between 30 to 50% right now, and stagger the rest over the next say 2 or 3 months. This is what my humble opinion is. And and to answer the second part of your question, is that I'm comfortable deploying my money in all categories, whether it is large caps, mid caps, and small caps. With today's fall, all three segments have turned very, very reasonable at this point of time. So I'm very comfortable investing in mutual fund, in all mutual fund categories. But investors should keep in mind is that they should choose funds based on their risk and time horizon.
Okay, fair point. Yeah, absolutely. If you're deploying right now, don't expect to turn a profit in the next couple of weeks, let alone the next 1 year. Think about the next 3 5 years. That's normally when you would invest in equities. Rushabh, on that note, thank you so much for taking the time. Pleasure speaking with you as always.
Thank you so much, Alex.
All right, that brings us to the end of this edition of Your Money Matters, and hopefully it's been helpful for you. If you've got something specific that you'd like us to talk about, then write to us on any one of our social media platforms and we'll take it up. In the meanwhile, stay tuned. This is NDTV Profit.